Welcome back to the Decentralized Finance lecture. Today we're going to discuss stablecoins, what they are, why they're important, and how they work. Come on, let's dive into it. We will start with a very basic background that enables us to really dive deeper into the mechanics of stablecoins in the following. One of the first things to understand stablecoins really in depth are economic models. So an economic model represents an economic process. And as models typically do, they simplify the real world, right? You want to simplify something, a system, in order to be able to analyze it more efficiently given various techniques. So a model contains variables, and we will look in the following slide what example variables are. But these variables often have a logical or quantitative relationship among them. So let's assume the example of the concept of inflation, right? Monetary inflation. So measuring monetary inflation requires a behavior model. So a model of how users or citizens in a country are purchasing goods and services with the fiat currency provided by the government. So such behavior model might obviously not necessarily reflect like the behavior of all citizens, but it might be representative enough to be an appropriate model for the majority of a population. Now, what's important is in such an economic model, you want to differentiate the relative price change from the inflation price change, right? So goods and services might, relatively speaking, change in price. So a product A and a product B might just change relative in price. But that's different from an inflation that might be caused by an excessive supply of monetary assets, whereby maybe an entire basket of assets is increasing in price due to monetary inflation. So these things are not always easy to capture in economic models. Now, what are different variables in economic models that we could consider, especially in DeFi, and that are related to stablecoins? So for instance, the interest rates in CeFi and in DeFi could be considered a variable. Note that the DeFi interest rates might be higher at the moment, at least, than CeFi interest rates, which is likely to come at out of the premium risks that users have in DeFi, such as custodian risks, security bugs, etc., that are less well understood than the rather well understood CeFi interest rates. A cryptocurrency price can be considered a variable. The collateral ratio of a lending or borrowing platform can be considered a variable. The DeFi protocol fees, like for example, if you exchange assets on an AMM, on a DEX, you are paying a certain fee. That's a variable. The blockchain transaction fees that depend highly on the frictions and on the current load of a blockchain. Obviously, the number of users can be a variable, the blockchain transaction throughput, etc. I hope you get the idea of what a variable is within an economic model. Given these variables, we can now understand which variables are so-called exogenous or endogenous variables. An exogenous variable, you can think of it as an outside force. So if you have a model and a system, it's really something that's outside and is acting on that particular model. So it's a variable that's determined outside of the model and then imposed on the model. So I think a great example is actually in MakerDAO, which you've already seen. MakerDAO, the asset prices of the collateral, so you're collateralizing ETH, right, is independent of the MakerDAO system itself. At least as long as the MakerDAO system is not excessively great in large in comparison to the Ether ecosystem. So the collateral ETH, right, this is the cryptocurrency ETH itself, can be considered independent or external to the MakerDAO system, and you bring this collateral into the system to collateralize ETH to then mint DAI, right? So you can think of it as an external component, right? And hence the asset price of the collateral can be considered an exogenous variable. An example of an endogenous variable would be something that's from inside the model, so something that's considered as part of the model or the interior. It's not an external variable. It's determined by the model. So if we're looking at synthetics, which is another stablecoin or like a packed asset, so there you're using the cryptocurrency SNX, which is a part of synthetics, as collateral in order to mint derivatives, right? So-called SINs. So, and this is a project internal token, hence you could say it's an endogenous variable, right? So I hope this really clarifies how exogenous and endogenous variable come and play and how they interact. They might interact with each other. So another quite important background knowledge to understand better stablecoin mechanisms is the reserve system, which can be a full reserve or a fractional reserve system. So in essence, a bank, right? If you have a bank that's receiving deposits, money deposits from bank customers, then the bank has two choices. Either it just holds the money in the bank, right? So it's basically a security deposit box, and it hands out the money again if the customer would like its money back. So that's one possible model of how to operate a bank. The other model would be to have a fractional reserve bank, whereby parts of this money that's deposited by bank customers, can be lent out to other customers. So this would imply that the money held by the bank, right? So this part here will actually become inferior to the money deposited by the bank customers in the first place. So the lower this ratio, obviously this bank's reserve ratio, the lower this ratio, the more dangerous this becomes for the bank itself. For example, if they are the majority of the bank customers are suddenly showing up at the bank and would like their money back, then the bank would not be able to pay back the money deposited by the bank customers, and hence the bank might default, meaning it would go bankrupt. It would cease to operate, cease to do business. However, having this ratio rather small is quite a lucrative business, because when the bank is lending out money that strictly doesn't belong to the bank but to its customers, the bank naturally can earn interests on that particular loan, right? Depending on the current interest rate set by the bank and the central bank. Okay, so this is really important to understand some types of stablecoins and also the potential risks involved with stablecoins. The next concept I would like to introduce is the concept of an exchange-traded fund, an ETF. So you might be familiar with stocks. Well, it's just a security, it's an asset that represents a share in a company, and these are typically tradable during the day, right? On the other side of the spectrum, you might be familiar with managed funds. So these are companies that receive your assets, they keep them within their deposit, and they invest it into assets on your behalf, right? So they're typically rather diversified, and you don't have to do anything. They're managing for you. They're taking a respective fee for their job. And in the middle of these two basically options, you have the so-called exchange-traded funds. So these are diversified, low-cost ways to invest into a variety of assets, as we'll see in the next slide. And these can be traded on a day-to-day basis, hence they're called exchange-traded funds. So they're really tracking anything that you would like. So it can be an index like the S&P 500, it can be an entire sector, it can be a commodity, etc. And as I mentioned earlier, they're tradable on exchange, hence the name ETF. Then typically they have lower fees than buying individual stocks. So fees, if you purchase and sell assets on the stock market or in general, the fees might really eat up your profit. So hence, keep an eye on fees, and that's why ETFs were or are rather popular, because they're exerting rather low fees compared to the purchase of individual stocks. There are a variety of different ETF types. There can be bonds, basically loans. There can be stocks, industry, commodity, currency, or even inverse ETFs. So an inverse would be something where you bet on the decline of the asset value of a particular index, sector, or commodity, for instance. So a particular example would be of an ETF would be the SPDR S&P 500, which is an ETF that tracks the S&P 500 index. It's an index of 500 tech companies. Voila! I hope this background will help you to further understand the subsequent lecture modules that will dive deeper into stablecoin basics and how stablecoin works in general.